Phase 2. Forex Technical Analysis Mastery. Read the chart story and predict price moves beyond basics. The story of the chart. Welcome back traders, to your journey towards financial mastery. If you've completed Phase 1, you've built an unshakable foundation, understanding the core mechanics of Forex. Now, in Phase 2, we ascend to the next level, technical analysis. This isn't just about drawing lines on a chart, it's about learning to read the story that price is telling you. Every candle, every swing, every rejection, it all speaks volumes about the battle between buyers and sellers. And when you learn to listen, you gain an unfair advantage. Today, we're unlocking the visuals. We're going to dive deep into candlestick anatomy beyond the basics, uncover the secrets of market structure, master the art of identifying support and resistance, draw trend lines and channels like a pro, and get a crucial introduction to indicators, not as signals, but as powerful filters. Forget what you think you know, because we're filling the knowledge gaps and equipping you with the clarity you truly need. Get ready to transform how you see the charts. Let's begin.
Section 1. Candlestick Anatomy, Beyond the Basics. Reading Momentum. First up, the building blocks, candlesticks. You probably know the basics: green for up, red for down. But a true trader reads momentum and rejection within each candle. Let's look at this bullish candle. The real body, that thick part, tells you the story of conviction. A long green body. Buyers were in strong control, pushing price significantly higher from open to close. The longer the body, the stronger the momentum. Conversely, a long red body signifies strong selling pressure. Simple enough. But here's where most people stop. The real magic, the true depth, lies in the wicks. Wicks, or shadows, represent price rejection. A long upper wick on any candle, regardless of its color, tells you that buyers tried to push price higher, but sellers stepped in aggressively and pushed it back down before the close. That's a sign of seller strength and potential resistance at that level. A long lower wick means buyers stepped in, rejecting lower prices, indicating buyer strength and potential support. Think of wicks as battlefield scars, showing where one side lost the fight during that specific time frame. By combining body length and wick length, you get a much clearer picture. Strong bodies with minimal wicks mean conviction. Small bodies with long wicks mean indecision or fierce rejection. Pay attention to these details, they are often the earliest hints of a shift in market sentiment. This is how you read the real story, not just the color. Section 2. Market Structure 101. The Architecture of Price. Now that we understand the individual bricks, let's look at the blueprint, market structure. This is arguably the most crucial concept in technical analysis. Price doesn't move in a straight line, it moves in trends, forming patterns. An uptrend is defined by a series of higher highs HH and higher lows HL. Think of it as climbing stairs. Each new peak is higher than the last, and each pullback finds support at a level higher than the previous low. Buyers are consistently overcoming sellers. Conversely, a downtrend is characterized by lower highs LH and lower lows LL. Here, sellers are in control, pushing price down, and any rallies are met with stronger selling pressure, resulting in a lower high. Moving on with the architecture of price, this is where the real gap filling happens. Most gurus tell you what a trend is, but they don't show you how to identify the exact moment it dies. Now, listen closely, because this is the break of structure, or boss. This is the pivotal moment in our story. In an uptrend, the structure is protected, as long as price maintains those higher lows. But the second price crashes through a previous higher low and closes below it, the uptrend is officially broken. This is your warning that the trend has shifted or is about to reverse. Section 3. Support and Resistance, the Floors and Ceilings. If market structure is the blueprint, support and resistance are the physical floors and ceilings. These aren't just random lines, they are zones of intense psychological pressure. Support is your floor. It's where price has historically struggled to fall below because buyers see it as cheap and flood the market. Resistance is your ceiling. It's where price struggles to rise above because sellers think it's expensive and start dumping their positions. But here is the secret the pros use: role reversal. Once a ceiling is broken, it often becomes the new floor. This is a break and retest. If you see price break through resistance, wait for it to come back and test that level is support. That is one of the highest probability entries in the game. Section 4. Trendlines and channels, precision drawing. Many traders force lines to fit their bias. We don't do that here. A trendline is only valid if it connects at least 2, ideally 3, significant swing points. Think of a trendline like a diagonal support or resistance. In an uptrend, we draw it under the lows. In a downtrend, we draw it over the highs. When you add a parallel line to the other side, you get a channel. This shows you the value area, where price is currently happy to live. Section 5. Indicators, the filters, not the signals. This is where most beginners fail. They look for a magic indicator to tell them when to buy or sell. Indicators like the RSI, Relative Strength Index, or moving averages are just math based on past price. They are filters. RSI, we use it to see if price is overextended. If it's above 70, the story says buyers might be exhausted. Moving averages, these act as a dynamic support or resistance. If price is above the 50-period MA, the momentum is bullish. Never take a trade because of an indicator. Take a trade because the structure is right, and use the indicator to confirm it. Preparing for execution. You've now learned to see the invisible lines that govern the markets. You can read the momentum in the candles, the architecture in the structure, and the pressure in the zones. But knowledge without action is just a hobby. In Phase 3, we're going to take these visuals and turn them into a strategy. We're going to talk about entry triggers and risk management.